Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Opendoor stock so we can determine if it's a buy or a sell. Opendoor makes instant cash offers on homes through an online process, repairs properties it purchases, and relists them for sale. It also provides mobile application-based home buying services along with financing. Property owners bid to sell their properties on the online platform. When a bid is accepted, Opendoor purchases the property as is, charging a fee. The company then makes necessary repairs before listing the property. Through this process, Opendoor carries an inventory of a lot of homes. The average time a property is held by the company is 90 days. Opendoor is headquartered in San Francisco, California, and was founded in 2014. It went public via a SPAC, Special Purpose Acquisition Company, in December 2020, raising nearly $1 billion, and the ticker trades on the NASDAQ and Mexican Bolsa. The company was founded by serial entrepreneurs Ken Roby and Eric Wu. Previous to this company, they founded Movity, a real estate startup that was acquired by Trulia. After they raised a $10 million venture capital round led by Khosla Ventures in May 2014, the company began operations. In 2018, Opendoor raised $400 million funding from the SoftBank Group Vision Fund. In 2019, it raised $300 million in a funding round led by General Atlantic. At the time, the enterprise value of the company was $3.8 billion. In August 2019, Opendoor launched mortgage services through Opendoor Home Loans, an in-house mortgage business. In September 2019, it acquired national title and escrow company OS National, allowing integration of title, escrow, and closing services under its business offerings. In early 2020, the company expanded services to more cities in partnership with Redfin. A few months later in 2020, they laid off 600 people due to COVID shutdowns. They suspended all home buying in March 2020 due to COVID. The company resumed operations a couple months later, May 2020, by introducing a contact-free platform to help people buy and sell homes digitally. In September 2020, their EV value was $4.8 billion. In December 2020, the SPAC officially approved the merger with Opendoor. In 2021, they bought 37,000 homes. In the beginning of 2022, the company began buying houses in the Bay Area. On August 1st, 2022, the Federal Trade Commission reported that Opendoor has agreed to pay a settlement of $62 million over charges of misleading potential home sellers in its marketing campaigns. In the fourth quarter of 2022, Opendoor sold 7,500 homes at an average loss of $28,000 each, compared to an average gain of $16,000 the year prior. In late 2022, co-founder Eric Wu was the CEO, but in early 2023, he was replaced by Carrie Wheeler. Opendoor reported a loss of $1.4 billion in 2022, after a loss of $662 million in 2021. Sales in 2022 were $15.6 billion. In November 2022, they cut 15% of its workforce, or 550 jobs. When they initially IPO'd in 2020, they had a market cap of $18 billion. In early 2023, the market cap was slightly above $1 billion. In April of 2023, Opendoor cut 22% of its workforce, about 560 jobs. And they said the reason was because of a declining housing market. They said new listings had dropped by 30% since their 2022 peak, mainly due to rising mortgage interest rates. Let's get started with the model. This is a small cap company. 1.9 billion market cap, they're trading at $3 a share, and they have 648 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a positive free cash flow in 2020, then a huge negative in 2021. They must have bought a lot of houses that year. But it is positive in 2022 and the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative each year, and it gets worse and worse, up to negative $1.5 billion. Revenue is the sales for the company, and that grew a lot from 2020 to 2021, from 2.6 billion to 8 billion. Then it doubled to almost 16 billion, but it has dropped in the trailing 12 months to 13.5 billion. Let's take a look at their most recent 10Q. This is for the first quarter of 2023. The first financial statement is their balance sheet, and the information is as of 3/31/2023 and 12/31/2022. Total current assets of 5 billion. That's a lot more than 440 million of total current liabilities. So their current ratio is well above 1. It's actually above 10. Current assets are assets that can be liquidated into cash within 12 months. And it's listed most liquid to least liquid. Cash is the most liquid, 1.1 billion of cash. Restricted cash, 1.5 billion. Restricted cash is cash that's set aside for a specific purpose. And their restricted cash went up from 650 million to 1.5 billion. So it increased about 850 million. And if you search the term restricted cash, you might get a little more information. This paragraph gives a little more color on it. The increase in our restricted cash balance of 861 million compared to December 31st, 2022 was a result of the proactive reduction of our acquisition pace via higher spreads embedded in our offers and lower marketing investment, resulting in greater restricted cash available for the future acquisition of real estate inventory. I think what they're trying to say is they're not buying as much inventory, not buying as many houses, so they have more restricted cash on their balance sheet, which can be used to buy houses in the near future. They say they may be required to keep restricted cash to collateralize their asset-backed term debt facilities. They may have a $100 billion facility that they could tap into to buy real estate. And let's say that facility gets low down to like 10 billion. Then they may have to keep restricted cash on the balance sheet to use as collateral for that facility. 108 million of marketable securities. If you're curious what the marketable securities are, 95 million of corporate debt, 12 million of equity securities, and 1 million of asset-backed securities. Of the 1.1 billion of cash, 258 million is actual cash. The other 885 million is money market funds, which is pretty much cash. They're sitting on 2 billion of inventory, which is less than half of last year of 4.5 billion. This is a number you really want to follow because if they're sitting on a lot of inventory, they may have to sell it at a loss. They don't have much in non-current assets, so they have 5.1 billion of total assets, lower than last year of 6.6 billion. A bulk of their liabilities are the asset-backed facility, 2.8 billion. This is the debt they use to buy homes. Their assets of 5.1 billion minus liabilities of 4.1 billion equals total equity of 1 billion. They've lost 3.2 billion from running their business. Accumulated deficit is a sum of all their prior net incomes, and they raised 4.2 billion from issuing stock. Revenue in the first quarter of 3.1 billion, down a lot from last year of 5.2 billion. Let's see if we could search this number to see what it is. I couldn't find a breakdown of the revenue number, but they do talk about how they generate revenue. We generate the majority of our revenue from the sale of homes that we previously acquired from homeowners. In addition, we generate revenue from additional services we provide to both home sellers and buyers. And that consists of title insurance, and escrow services and brokerage services. So let's say they buy someone's home for $100,000 and they sell it for $110,000. They made a $10,000 profit. They also charge fees as well. I wish they gave a breakdown of all the numbers, but I can't find it. Their cost of revenue is $3 billion. So in the first quarter, they spent $3 billion from buying people's homes, and they sold those homes for $3.1 billion. They made a profit of $170 million. That's the bulk of their revenue and cost of revenue. There are other things in there, like escrow fees and other fees. But the bulk of it is the cost of the home and the sale of the home. They spent $188 million in marketing, $66 million in G&A, $40 million in technology. So their operating expenses are higher than their gross profit. So they have an operating loss in the first quarter. They spent $74 million of interest on their debt, a net loss of $101 million. That's a 16-cent loss per share. Last year, they had a gain of 5 cents. They're adding shares. Last year, they had 619 million. Now they have 642 million. This is their statement of cash flows. They generated $2.2 billion of cash flows in the first quarter. That's mainly from getting rid of so much inventory. They got rid of $2.3 billion of inventory off their balance sheet. Even though they sold the inventory, they lost money because they sold it for less than they purchased it for. Let's look at their financing section on their statement of cash flows. They repurchased $101 million of convertible notes. They received $224 million of asset-backed debt. They paid back $1.4 billion of asset-backed debt. So in their financing section, they had a cash outflow of $1.3 billion. Let's go through their first quarter press release. In the first quarter, revenue of $3.1 billion, down 39% compared to the first quarter of 2022. 8,300 homes sold, that's down 35%. Gross profit $170 million, and gross margin of 5%, down from 10%. Net loss of $101 million versus a gain of $28 million. Adjusted net loss $400 million versus a gain of $99 million. Adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, negative $341 million versus a positive $176 million. Things are getting bad for this company. Their inventory is $2.1 billion from 6,300 homes, down 55%. We saw that earlier on the balance sheet. Their inventory is down. They purchased 1,700 homes, down 81%. They ended the quarter with 1,137 homes under contract, down 86%. Their guidance for the second quarter is $1.75 to $1.85 billion of revenue. And their guidance for adjusted EBITDA is negative $180 to negative $200 million. Let's see what Simply Wall Street says about this stock. Here's their big competitors: Redfin, market cap $1.2 billion, MMI $1.3 billion, eXp World Holdings $3.1 billion, and Newmark $1.6 billion. Here's the stock price since it started trading. Its highest point was $31.25, and it's down well over 90% since that peak. Here's some recent news articles. Co-founder notifies of intention to sell stock. Eric Wu intends to sell 2 million shares in the next 90 days. At the current stock price, this will give him $4 million. Since September of 2022, he has decreased his holdings from 35 million to 31 million. The stock is up in the past 7 days, up 19%. The US real estate market is up 1%, and the US market is up 2%. But in the past year, the stock has gotten crushed, down 42%. The US real estate market up 3%, the US market up 15%. Their EPS in the trailing 12 months is negative 228, gross margin of only 2%, net profit margin of negative 11%, and debt to equity ratio of 380%. Their sales are much higher than their market cap. Sales of $13 billion, market cap of $2 billion, so their price sales ratio is 0.1. That may sound really appealing, but they lose money on most of their sales. There's that famous saying, we lose money on every sale, but we make it up in volume. The price of sales of their competitors are much higher. Newmark is 0.5, Redfin is 0.6, XP 0.7, and Marcus Millichap 1.1. They're growing their sales the highest at 10%. Redfin is negative 7.5%. Their price of sales was 6 in the first quarter of 2021, but the reason the price of sales looks so much more attractive is because the stock price has come down so much. As the stock price goes down, the price of sales gets more attractive. All the price multiples get more attractive. Their revenue forecast in 2025 is $12 billion, $8.8 billion in 2024, and $7.8 billion in 2023. Analysts are forecasting their earnings to grow 42%, the industry 32%, the market 16%. And they're forecasting their revenue to grow 10%, the industry 8%, the market 7%. This is their earnings and revenue since 2018. So you can see their revenue is getting high, but their earnings are getting worse. They've always had negative earnings. Their short-term assets are a lot higher than their short-term liabilities, but their long-term liabilities are a lot higher than their long-term assets. This is their debt-to-equity ratio since 2019. Currently, their debt is a lot higher than their equity. At one point, their equity was higher than their debt, but only for a few months. It looks like the CEO's salary is $380,000. Eric Chung's compensation is $350,000. The interim CFO is $2.1 million. The chief legal officer is $4.8 million. And one of the advisors is $1.5 million. The reason it looks so high is because of options and employee stock. Their base salary, I'm sure, is lower than the CEO's. There's only been one insider trade in the last year. GGV Capital sold 8.9 million shares, and they sold it for $2. It's trading higher than $2 now. 55% of the companies held by institutions, 26% by the general public, 8% by private companies, 5% by insiders, 5% by hedge funds, and 0.03% by the government. The biggest shareholder is Vanguard at 10.5%, Access Industries, Celebra Capital, BlackRock, Slate Path, Eric Chung, First Trust, T. Rowe Price, GGV Capital, and a bunch of other companies. They had under 1,000 employees in 2020. It peaked at 2,800 at the end of 2021. It's down a little bit to 2,600 currently. And it looks like the stock trades on the NASDAQ, Mexican Bolsa, and Deutsche Börse. Let's look at the stock on Yahoo Finance. They have a pretty high beta, 1.8. So the stock is pretty volatile. It's down 43% in the past 52 weeks, while the S&P is up 15% in the same time period. The 52-week low was 91 cents. The high was 640. And there is a lot of trading activity. About 23 million shares are traded each day. Of the 648 million shares outstanding, 526 million are on float. When a share is not on float, that means it's held by an insider and it can't be bought or sold. 69% of the company is held by institutions. 73 million shares are short. So the short percentage of float is 14%, which is pretty high. Let's go back to my Excel file. This is their capital structure. 1 billion of equity, 4 billion of debt. They're 21% equity, 79% debt. Their net debt is 2.7 billion, so they have about 1.2 billion of cash on their balance sheet. I gave them a WACC of 15%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.3 billion. We divide that by 648 million shares. And we get a calculated stock price of $6.59. They're trading at $2.93, so they're trading at a 56% discount. It's a buy according to the model. This is a really tough stock to value. I did a video on them in May 2021. They were trading at $15. My value was $6.70. And you can see the stock dropped well below my $6.70 target. It is good to see that my current target is fairly close to my target in 2021. But even though I say it's undervalued, I would not buy the stock. 9 analysts priced this stock and the average price target is $3. The low is $120, the high is $8. Another 11 analysts priced this stock and the average price target is $235. They say the stock is 13% overvalued. This is where the stock has been trading historically. So when a SPAC starts out, it always starts at $10. Once the SPAC announces they have an acquisition target, the stock price usually goes up, even before they acquire the company. And I think they acquired them in December 2020. So it got up to $20 a share before they even acquired the company. Then a few months later, it peaked at $40. And then over the next 6 months, it got down to below $15. This is mid-2021. It did run up to 23 by October 2021. But ever since that point, it's only gone down. It did fall to below $1 at one point. But I wouldn't be shocked if this company files bankruptcy within the next 3 years. There are 44 companies in the same industry as Opendoor, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They only spend $35 million in CapEx, which is more than median, lower than the average. They have a pretty weak debt to equity ratio. For every dollar of equity, they have $3.90 of debt. Of course, they don't pay a dividend. They don't really have any extra funds. They did generate positive free cash flow. They rank 12th in market cap at $1.9 billion. They do have really good price multiples since the stock price has come down so much. They generate a lot more revenue than the average company, and we can't look at their 5-year annual revenue growth rate since they just recently went public. So to summarize, I have them trading at a 56% discount. They've been around 9 years, and real estate flipping is really hard to do on a large scale. On a smaller scale, you can definitely make money. It's not easy, but you can make money. But on a really large scale like they're trying to do, very few companies have had success. I ranked their free cash flow 7 out of 10, their revenue 6 out of 10, and their ratio 7 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.